That's SBI Life. That's the top Nifty gainer, trading with gains of almost 3%. This upbeat, strong move is coming in after posting a strong set of numbers for Q2. My colleague Ankur Mishra also caught up with the MD and CEO Amit Jhingran on their growth outlook. Let's go across and listen in to what he had to say.
If you look at the first half numbers, we reported 27.8% for the first half year and 28% for the second quarter. So, looking at all the effects plus and minus, we are sure that we will be able to stick to over 26 to 28% margin range.
Right. Talking about the net profit, I want to understand that what has been the reasons of the decline? Is it just the cost pressure or something else?
In the life insurance industry, the profitability is looked more by the way of the new business, the value of new business that the business is creating. On the current year profitability, there are various aspects like the strain of new business also. The more new business you write, the more protection business you write, there will be effect on your profitability for the current year. So, this is this reduced profitability of 4% for the quarter is a result of the GST effect as well as the new business strain.
You spoke about the GST impact. Some part of it is already taken. How much of the assessment is there that in the second half impact will be there, and more importantly, how will you offset that impact?
The impact of GST as calculated by the company for the entire year is going to be around, on the VONB margin, it is going to be around 1.4%. But we have several levers, operating levers within the company. We are trying to improve our product mix. We are trying to write more of the higher margin products, which are also in customer demand, like non-linked products, etc. And then we will be looking at other operational levers to offset this. We are pretty sure that to a very large extent, we will be able to offset this effect. But at the same time, a lot of effect will also be covered by the additional business that the company will be writing because of the reduced pricing in the market.
So, it's more of a volume game now. The margins you are trying to improve, but the volumes you are trying to increase. Is that a correct understanding?
So, I think that is the intention of the government also. It is a very good enabler. India is a very price conscious market, and this impact of GST on the pricing will definitely help government and industry to reach its goal of insurance for all by 2047.
Talking about APE, that has also posted impressive number this time, over 5,900 crore. What is your guidance there in the second half?
For the APE, individual APE, we have been guiding for the entire year growth of around 13 to 14%. And looking at the numbers that we have achieved in the month of September and the current trends up to date in the current month, we are sure that we will be sticking to individual APE of around 13 to 14% for the entire year.
Right. So, what is your strategy from here, from the second half? Of course, as you mentioned that the impact of GST will be there. You have to increase volume, but which are the new products you are focusing where you can achieve the same?
If you look at the company's track record in launching products for last 1 year, you will notice that we have been launching new products in the non-linked segment, which is a focus area for the company. We have launched guaranteed return products. We have launched protection products at very competitive price points, and we have launched products in participating business also like money back, etc. Good thing that for all these products, the numbers from the market, numbers from our distribution have been very encouraging, and whatever growth we have registered in this first half year is coming from these non-linked portfolios only. Our ULIP sales are almost at the same level for this half year as were in the last half year of the last financial year, first half of the last financial year. So, the entire growth coming from these non-linked portfolio is helping company in maintaining margin and profitability.
You mentioned about the ULIP one, as you mentioned about the impact, it is as it was there last year. But in terms of share, it has been reducing. What is the focus there? Do you think that further reduction in ULIP is being strategized by the company?
So at the start of the year, we were looking at a 64-36 kind of a mix, which was approximately 500 to 600 basis points lower than what we achieved in FY25. We are happy that the distribution, the market have responded to our strategy, and the ULIP mix in the first half year has reduced to almost 65% on the individual rated premium basis, IRP basis. We are very sure that further improvement is possible, and we will be achieving our target of 64-36 by the year end.
One last thing before I let you go, the bill of insurance amendment bill is there, must be there in the next session of Parliament, and that is the anticipation. And in that, there are several of the things which government is considering. I wanted to know your view as well on the the kind of amendments which government is bringing in, and more importantly, the use of the agents which can be there everywhere. So if you can provide your view on that.
Let us see what are the exact components with which the Insurance Amendment Act is passed, and then we will discuss that.
All right, with that, it's a wrap on this edition of Market Fatafat. I'll take your leave, but thank you so much for tuning in. Don't go anywhere because Closing Trades is coming up next.